can you actually use an SBA loan to acquire a business that's not profitable? So first of all, the answer is yes, you can acquire a business that's not profitable with an SBA loan, because you may talk to some lenders, you're probably going to hear them tell you that you can't, just decline out of hand. That is not the SBA rule, okay? The SBA is going to say that you need to be able to demonstrate that you can cash flow in the future going forward. It's probably just the bank's internal policy, but that's not the SBA rule. The real reason here, it says most SBA lenders do require the deal to show that the loan repayment will be possible from day one. This is called meeting that debt service coverage ratio. And if the business is not profitable, you'll need to be able to show another repayment source. Here's what you're going to need to do in improving your case. A turnaround plan with documented improvements. The more data you can back that up with, the more likely the lender is going to be willing to take those projections. Another big one is additional income source. The reason that they approve the loan is because maybe your spouse is a physician with a whole bunch of outside income and really steady outside income, and they're willing to co-sign on the loan. And maybe the loan amount that you're requesting is relatively small, and so you can get comfortable with a deal that is not profitable. Having some seller carry or seller note where you're paying the seller over time, the seller doesn't get all of that paid up front. That's another common thing. Another thing is that, typically in an acquisition deal, you're only required to put in 10% equity into the deal and you can borrow the other 90. But in a situation like this, if the business isn't profitable, probably looking at 20, 30, 40% equity, right, can strengthen your chances. And then collateral, if the deal has collateral and the lender feels comfortable that, hey, even if the business can't repay the loan, and even if you personally can't repay the loan, we've got collateral to back this up and we could get our money back that way. Lenders don't want to rely on collateral. That's not what they don't want to get repaid based on liquidating your collateral. They want to get repaid based on cash flow. So that's why this is kind of at the bottom of the list here. That's not really what they want to be doing.